The markets have been brutal the last few weeks, but I keep seeing people making the same mistakes over and over again. By the end of this video, I'm going to show you exactly how you should be looking at projects in crypto. And if you're not looking at them in this way, you're basically lighting money on fire and praying for things to change. This video is for information and entertainment only. It reflects my personal opinions and is not financial advice. Check the description for more information. Always do your own research. Hey guys, I'm Alessandro, and I research crypto and macroeconomics every single day and distill it down into ideas for you to take away very simply. There's one mistake I keep seeing people make when it comes to valuing altcoins. And basically, they're being valued on hopes and dreams and not the underlying fundamentals of what they're actually producing. So I promise you, by the end of this show, you're going to understand a framework for truly being able to make sense of what should and probably what should not have value in this space. Now look, most people would never invest in a company like this. No revenue, no real users, no growing market, no competitive advantage, no clear path to profitability. People would never invest in something like this. But in crypto, it happens every single day. And these are the vast majority of projects that exist. Now, just as an aside, you can basically remove Bitcoin from this equation because Bitcoin is something else entirely. We should probably do a full show on it. But for whatever reason, Bitcoin essentially trades like levered tech. It's traded basically one-to-one with a particular ETF for the last few years called IGF. It's basically a software as a service ETF. Kind of odd that Bitcoin trades like this. But fundamentally, the market has essentially priced Bitcoin as tech. I don't think that's an unreasonable thing for it to be honest. Bitcoin is a technology. It should probably be priced like technology. It's just a very specific niche sector of tech. Now this actually helps set the scene for the rest of this idea because crypto isn't special. It doesn't exist in its own random little world. It is just the tech industry. And when professional investors are looking for things to buy, right, looking for things to invest in, they're looking for three things. Is the total addressable market growing? I.e., is the pie getting bigger? Is the thing that's being invested in the company, are they taking a larger share of that pie? Because obviously if the total addressable market is growing and the individual company's share is growing, then they're going to be hit twice, right? They're going to get double gains. And you need that when you're investing in startups. Is cash flowing back to the business? Is the business actually reinvesting the money that it makes? Has it got positive free cash flows? Are they going back into growing the business, or is a CEO extracting all that money? Obviously, you know which one would probably be better and what investors are looking for. And this is where it gets kind of obvious. Crypto is just on-chain businesses. All alts are businesses that exist on-chain. You know, layer ones sell block space. There's loads of L1s that all sell block space. Some of it's cheap, some of it's expensive. They sell the same thing. DeFi protocols they sell financial services. Again, they just happen to exist on chain. Lending, borrowing, you know, Hyperliquid, AAVE, Sky. These are all DeFi protocols. They just exist on chain. And there's obviously applications as well. They just are trying to sell products to end users or trying to acquire end users and then monetize them in some way. SocialFi, 𝗨𝗏, for example, gaming. Obviously some games launched, some games didn't launch. Payments, these sorts of things are applications, but fundamentally at every single layer, they're a business. And that business needs to A, make revenue, B, be in a market that is growing, and C, somehow drive that value back to token holders. The thing about on-chain businesses is they scale faster than anything in history. They scale rapidly, like Axiom, Pump. These on-chain businesses, for whatever reason, they scale much quicker than traditional tech businesses. Not only do they scale really fast, like they grow to $100 million in revenue very, very fast, they also do it really efficiently. On-chain businesses need far fewer employees. Tether is one of the most efficient companies in the world. Hyperliquid is the most efficient company in the world when you value it on revenue per employee. Now this is traditional tech is down here. This is a massive differential that you can see. As a result of the on-chain nature of these businesses allow the applications that exist to be incredibly efficient because they outsource the need for infrastructure and security and all that sort of thing to the base layer underneath. Anyway, on-chain businesses just happen to be the most efficient and quickest to scale in the world so far. But these businesses used to be valued at about 250 times their sales. So whatever they were making, they were valued at about 250x that. Since 2021, this multiple has just been getting compressed more and more and more. And now actually, the valuation of these on-chain businesses is largely in line with normal equities. So the SPX typically trades at 20-ish, 25-ish price per sales ratio. And actually that's where the vast majority of these on-chain businesses have trended towards now. It's just that they were massively overvalued back in 2021. On-chain is beginning to chip away more and more at centralized players, right? So the on-chain space is growing and it's taking market share from its centralized players. This is just SEX to DEX volume, but you can see every year it's just growing a little bit. And now in 2025, the biggest year ever of DEX to SEX volume at 30%. More and more volume that's being traded is going on chain. But building businesses is hard, right? Most fail. Most startups fail. Most businesses eventually fail. And if we think about crypto as on-chain businesses, again, L1s raised billions in 2021. Most peaked and just never really recovered, right? The treasury raised a bunch of money, and fundamentally, two have really survived: Ethereum and Solana. Gaming, some games raised, again, hundreds of millions, and some of them never even launched. Dozens of L2s now with minimal TVL, no users. Linear raised $75 million. Total cumulative raise for L2s was probably nigh on close to $750 million. An enormous sum of money, considering that TVL isn't even close to those figures anymore. And of course, we had loads of DeFi applications that were launched and basically all failed, whether it was forked protocols, liquidity mining, where once the token incentives dried up, users just left. They didn't have a business model that worked, right? Their business model didn't attract enough new users. It didn't bring in enough new revenue. So eventually those businesses just can't succeed anymore. Now, this isn't all crypto, obviously, but you have to start thinking about projects as businesses. And if you don't, well, you're just going to be praying for your thing to recover, which is not a very good strategy for long-term investing. And so if we begin to think about this framework, right, this framework's very simple. Is the total addressable market growing? Is the total share that this company, this application, this protocol, is it taking more of that market share as well? And is there value accrual back to the token? Here are just some examples, and these are absolutely not in any way, shape or form recommendations to go and buy these things. You can do whatever you want. I just want to give a framework for whether or not something would actually constitute as like an investable asset from asset managers. AAVE is a good example, right? Because the total addressable market of AAVE is, in my opinion, growing. DeFi lending is growing because more and more RWAs are coming on chain. As more RWAs come on chain, what's a very, very common thing? Buy, borrow, die. If you didn't know what that is, that's a very rich man saying for you buy assets, you borrow against them rather than sell them, and then you die with debt tied to those assets. So you never really sell your best assets, you just let them accrue value and compound over time. And then you borrow against them. AAVE obviously allows for this just on chain. I'm not saying you should go and borrow 50% against your ETH. That's the sort of shit that ends up on the liquidation page that gets hunted. But the premise remains that ticks all these boxes. Growing market share, they already hold 60% of DeFi TVL, and they are accruing value back to the token. They're doing about $1 million in buybacks per week from fees that they're making. $43 billion in TVL, $530 million in annualized fees. No, not all those fees are used for buybacks because a lot of those fees are distributed to users on the protocol. Sky is another good example. Used to be called MakerDAO. Now, Sky again has a total addressable market that's growing. They're fundamentally a stablecoin business. Are stablecoins growing? Yes, absolutely. Are we getting more adoption of stablecoins? Yes. Are they taking a larger market share? I mean, they actually are growing. Their stablecoin is growing in a market that's growing. So it ticks both those boxes. And also, they have some direct value accrual as well. Now, again, doesn't mean you should go and buy Sky. This is just an interesting way to consider that Sky's been quite a good performer relative to the rest of the market. And why is that? Well, because it abides by these three things. Hyperliquid probably needs no introduction. Spoken about Hyperliquid at length multiple times. But again, very, very simple. Is the total addressable market growing? Well, yeah, we've just seen that SEX to DEX ratio, so the amount of trading that's happening on chain relative to off-chain is increasing. They're capturing more of that market. Now, is the total addressable market growing? Well, yeah, because Hyperliquid are doing things like introducing new ways of bringing users to their platform. We just saw last week, Silver had enormous volumes. Hyperliquid captured about 3 or 4% of the entire globe's silver trading volume on the day when it sort of went to $100, $120, and then had that massive crash. That's a clear increasing market. And again, obviously Hyperliquid has enormous direct value accrual. Basically all of the fees, 98% of them are used to go and buy back the token. A few days ago, they made about $6.5 million in fees when Bitcoin crashed to 60K. All of that was used to go back into the token. Another interesting example that you might want to go look at, I actually did a full show on Maple back in the summer actually, which was kind of interesting, but go and have a look at Maple, because again, very, very simply, they are growing. They abide by all 3 rules, right? They exist in a market that's growing. Institutional private credit, bringing that on-chain is absolutely something I can continue to see growing. In 2025, their TVL or their AUM grew by 10x. I mean, enormous. And they're taking more market share from that particular market. So, and of course they have some, again, direct value accrual back to token holders. About 25% of protocol revenue is used to buy back the token. Obviously, not everything is a clear pass or fail. In fact, not everything that I've said above there is necessarily true. I might be wrong on some of those assessments. I could easily be wrong on some of those assessments. But if we stress test this kind of idea, does Pump Fund fit it? I mean, it has taken market share from meme launchpads and done very, very well. It's fended off, every competitor basically. It does have direct value accrual back to the token. They've bought an enormous amount of Pump back off the market. But is the total addressable market for Pump growing? Personally, I don't really think so. I think meme coin traders are a highly speculative group of people who go wherever the money or the hype happens to be. Maybe it comes back to memes. Maybe it's prediction markets in 2026. Maybe it just remains as being perps. This casino might pick up again. For Pump to grow properly, they need to grow their market. And obviously they've got this idea that they're going to be a social media platform. Now that would obviously be quite good. That would be an increasing total addressable market, but it remains to be seen. And actually the market is pricing it as such. They have enormous buybacks and the market arguably hasn't really taken much care of that. It's again, this unknown of what market are they actually going to be capturing in the future. Before we continue, I just want to tell you quickly about today's sponsor, Uphold, a long-running digital asset platform offering access to crypto, stables, traditional assets all in one place. They've been operating for over a decade and support a broad range of assets from crypto to RWAs, even gold and silver. You put a very strong focus on transparency and operational disclosures, including publishing reserve balance data that many platforms still don't. One of the most annoying frictions in crypto is moving money from on-chain into everyday spending. Uphold offers a payment card that allows supported balances to be spent directly. Crypto is unforgiving. You can lose all of your money. There is no safety net and no one will protect you from bad decisions. Only get involved if you understand this. Thank you very much to Uphold for sponsoring today's video. Ethereum is a very good example, right? Its total addressable market is definitely growing. We're seeing more RWAs come on chain. Ethereum is the home for RWAs. We're seeing ETFs come on chain, tokenization, all these hot narratives. Ethereum is basically front and center for all of those things. But is it taking more share? Well, L1 fees collapsed because they were too expensive. They also shared a bunch of their fees with L2s. That's been relatively cannibalistic for the chain. They're also losing market share to other L1s like Solana. Arguably, there isn't enough value accrual back to ETH the token. Now, ARK Invest launched a paper for 2026. They basically applied 90% of Ethereum's value, of ETH's value, as a monetary asset, not because of its technological abilities or because it was a good business. Personally, I don't really think that's good for ETH overall, for ETH the asset. I think ETH the asset needs to have some direct value accrual back to the token. I think ETH the asset needs to take more market share. I think ETH the asset might need to dust its hands, like Vitalik mentioned the other day. Vitalik is the creator of Ethereum. He came out a few days ago and basically said he thinks that the L2 roadmap was wrong and they're going to have to rethink all of the L2s because they've cannibalized Ethereum so much. I mean, applications on Ethereum can make loads of money. Uniswap has made loads of money, Lido has made a lot of money, AAVE has made a lot of money, Sky, as we mentioned, made a lot of money, but they go directly to the application and to maybe users of those applications. Ethereum only sees the transaction fee. And so there's a massive question there, right? There's no law forcing value accrual for token holders either. Now, this is actually really, really important because tokens used to carry a premium, but buyback programs can be paused at any time. Hyperliquid's buyback program is not built into the code. It could be just turned off if they wanted to. Tokenomics can change through governance and votes. Treasuries can be drained. Smart contract risk means that things could be hacked at any time. Tokens used to carry a massive premium, and now we're seeing tokens begin to trade at a discount relative to normal companies. Remember what we saw above. On-chain businesses are some of the most efficient businesses in the world that scale faster than anything we've ever seen. There's a real reason to think this is a bullish thing for on-chain businesses, but the selection of what is and what isn't a successful on-chain businesses is the most important thing anybody can do with the tokens that they're actually holding. And so people just have to ask like 3 questions before buying or holding anything, because you need to be really, really clear, right? Not buying and selling are the same thing. Not selling and buying are also the same thing. When you remove the tax implications, which are obviously relevant, but generally if we just think about this from a first principles perspective, if you hold something and you choose not to sell it, that's the same as buying it. If you sell something, that's the same as not buying it in the first place. So holding something is choosing to buy it today. That is something that people often struggle with. Mainly it's because of the sunk cost fallacy, but if you're holding something that you wouldn't buy today, then that is the equivalent of buying that same thing today. And these 3 things are basically the questions that have to be asked, right? We've been through them already, but just to really recap, is the total addressable market growing? If the industry isn't expanding, even the best product has like a really clearly defined ceiling. Is it taking an increasing share of that market? A growing market means nothing if the protocol in and of itself, the business, isn't winning in that space. Share growth equals a bigger moat. It means it's much harder to chop down if it's actively growing. And then finally, is there some kind of sustainable cash flow and value accrual back to the token? Revenue somehow needs to come back. It could be buybacks, staking rewards, fee distribution. Personally, I much prefer buybacks. I don't really like staking rewards because when you only reward stakers, yes, you reward the small group of holders that are more aligned with the token generally, but it's not very good for the token price. The token hasn't got that consistent underlying bid. And I think from a marketing perspective, you want to see token prices do well. If they just reward stakers, it does nothing for token price. And so this is all I wanted to say really. You must treat alts like businesses. If you don't, then you're just going to get treated like exit liquidity. Altcoins are just businesses that exist on chain. And yes, I think some of these businesses are going to be the most efficient businesses in the world and scale to be some of the biggest businesses in the world. However, the vast majority are going to fail. The vast majority have failed and will continue to fail. So being selective, choosing ones that genuinely do all those 3 things above, personally, is what I'm doing with my money. And what I think is the best strategy. So guys, let me know what you thought about that. Comment with your favorite alt in the comments and let me know how close it is to getting through these 3 hoops. If I could ask one favor, please go check out my latest podcast with 𝗵𝗵𝗃𝗀𝗏 on risk takers. We go into loads of details around about Ben's theories on the market, where he thinks we're going for 2026, and specifically why he has been able to call things so right and what's given him the ability to carry out that analysis so effectively. So please go check that out here. Otherwise, I hope you have an excellent day. Thank you ever so much for watching, and I shall see you in the next one.